Today I want to talk to you about how I made 100x returns in crypto safely. And I know that sounds like a crazy claim, but hear me out. Crypto is an extremely volatile asset. But if added to your portfolio in small quantities, it can actually help diversify in such a way that it might stabilize your portfolio a little bit. Now, I'm not smart enough to speak into all of the extreme economics that backs that up, but I read this book called Crypto Assets. It's got a whole chapter on understanding how just like a 1 to 2% holding in cryptocurrency that goes like this can stabilize the stock market a little bit to diversify your portfolio, right? Because what ultimately happens is those big upsides will outweigh the big downsides if you play your cards correctly. Now, I took this and some other investing fundamentals, and I developed a crypto strategy that took my maybe $2,500 that I invested, grew it to $15,000 over the last year, which is a still small portfolio, small percentage of my net worth. I could have done the same exact thing with a lot larger numbers and probably had the same exact success, right? But I did it in such a way that I could afford any losses, and anything that came down didn't really matter against the principal. So hear me out. I did buy, and I did this doing meme coins and normal coins, right? It's not like this is just a general rule of thumb for investing in volatile assets. So what I did is actually the first coin that took off for me. The first investment I made was XRP. I put about $1,000 into XRP. I have not touched that because I fundamentally believe that that is going to do very well once the SEC comes out and says thumbs up and people allow it to trade again. Waiting on that day, right? But in the meantime, what I did was some other investments, right? So the other stuff is what we're going to talk about, right? Because the XRP is just a long term. Eventually that'll figure itself out and it'll be good for me. Right. The other stuff, the first one I invested in was Dogecoin. Now I know I probably just lost credibility to a lot of you because, oh, Doge. But hear me out. I bought it before anyone knew what it was. I bought Doge for 1/3 of a penny. And so I bought it because in June of 2020, which was actually maybe May, long before it became popular, I just happened to see an article about it, and I was like, the Doge dog. All right, that's funny. And then I realized, I bet other people will think this is funny. I bet you this will go viral at some point on the internet, and when it does, people will take that virality and buy into Dogecoin. And so I'm just going to hold it until it goes up, whenever that initial spike is, and then I'll sell it out, and we'll see what happens, right? And my thought was, hey, it goes up to a penny or 2 pennies, I tripled up, 6 times, whatever, and then I take my investment, I pull it out, bada bing, bada boom. Little did I know how much it was going to go up, but what I did was, I bought it at 1/3 of a penny, and when I woke up one day and it was at 1 cent, I sold out that original $200. So I took the principal out, right? And so now, picture this, I had $200, I pulled the 200 out once it hit $1 a share, or a penny a share, which equals $600 change. So in essence, I took my 200, invested it. It grew to 600. I pulled 200 out. I had 400, right? Still had been originally invested at 1/3 of a penny, but we'll say $400 worth at a penny a share. When that went up to 2 pennies a share, so it doubled again. Actually, I think it was like 2.5 or 3 by the time I did this. But once it, more than doubled again, I pulled the 400 out, right? So now, again, pulling the principal. So now I've got $600 put away, which is 3 times my original investment. And the rest, I could have just let ride. And I probably should have, because I would have been able to sell it 50, 60, 70 cents. And it would have cha-chinged. But I sold it at 7.5, 8 cents. Because I was like, all right, this is enough of a ride. I'm content, whatever. And so I took that $200 and I turned it into about $2,000, right? Maybe 22, 2,300. I don't remember the exact numbers. I'd have to go look at my trades. What I did next was I took that, we'll say $2,000, and I put anywhere from $100 to $200 into 10 to 20 cryptos, right? So I diversified this. And what I was doing is this. The thought process behind this is, look, if you put $100 into 20 cryptos, if 10 of those go down 50% in value, then I still have $500 there, right? So that takes my $2,000 and bumps it down to $1,500. But if one of those goes up 10x, right? So that would be $100 grows to $1,000. That's a $900 gain, which outweighs all 10 of those getting slashed in half. Now, if 2 of those go up 10x. Now you're talking your portfolio is up from 2,000 to 3,800 and the $500 loss. So now you're sitting at 3,300. That's a 50, probably, I don't want to do the math on the 300, but that's over a 50% jump again. And so what you can do here is what I would do is every time one of these like took off, I would pull out $100. And if it took off again, I'd pull out a little bit more. If it took off again, I'd pull out a little bit more. And then when it tanks, who cares? I already pulled out more than my original investment. So let's say you buy a stock for $200, it goes up to $1,000. You could pull the 200 out, or you could pull 500 out, and now you've taken the profit on whatever the loss is on these other 500. So now you're break even if this other one tanks, right? And so this is kind of the crazy philosophy. And I just kind of kept doing this. And so along the way, I hit a couple gold mines, right? One of which, and probably my most profitable in the long term, was Mana, or Decentraland, which I originally put in $200. And then, I'm trying to remember exactly how this went down. This one I think I actually put $500 into it. Okay, so I put 500 in because I read about the game and I was like, it's a cool concept. We'll see if that takes off. This was, mind you, like 8 months, 9 months, a year ago before Metaverse was discussed. And so I put $500 into Decentraland or Mana, whatever. And when it went up to 1,000, I sold $500 worth. So I'm back to 500 and I pulled my principal. And then it dropped. And so when it dropped, I was like, I wonder if that's going to go back up. And so I put another $500 into it, which normally I don't do. Normally I wouldn't have played that game, but I like this one enough that I thought, okay, I think this has gone down. I think it actually went down more than when I originally bought in. So I was like, okay, you know what? We'll play the game again. So now I've got the 500 that I sold, at the top. So that's back down, still $500 worth, or still, now it's shrunk, but it's like $250 worth. And then I've got this other 500 that I throw in. So I'm sitting at like 750, and then it went up again. And so like this one, literally, I put 500 in, I pulled 500 out, I put 500 back in, and then it jumped, and I pulled the 500. So now I've got no principal left in it, and then I pulled 1,000, and then I think at this point I've pulled like three to 3,500 out of this, and I still have a $2,000, like over $2,000 holding in Mana. So this one did very well. That originally $500 has now become like $5,000 over time. Would have done even better if I hadn't been pulling the principal. So that's the downside. If you pull the principal every time it goes way up, you're pulling out money that could continue to double if that crypto continues to run, but you're mitigating your downside, right? You can't go broke taking profit. In this case, so a lot of people, what they do is they leave the principal and they pull the interest, right? That way you never touch the principal. It's always there to earn. That's a good rule of thumb. I like to look at it as the other way, or if you pull your principal out, now you have your original investing power always, and your interest just runs free. It's just free money. If you lose everything on it, who cares? Whatever. It's just free. It just runs. And then there were some others, like Algorand did really well. Let's see. I wrote some down. Shiba. Yeah, I mean, that's literally it, right? My big ones were Doge, because I got in way before the hype. I didn't make much on Shiba, but I made some. Decentraland, Mana, XRP I think will be a big one. Algorand. There were some others, right? There were actually plenty. So at one point I had like close to 40 coins in my little Coinbase wallet, and I was, there were at least 15, if not 20, that were under $100 in value, right? And some of those I'd put $200 in. So I mean, some of these lost big. Most of them were like, they'd gone from 100 to like 70 if they were down there. And I ended up selling all that stuff off, right? Whatever. Mainly because I wanted to move that cash into some investments that I had some control over, some real estate and some other stuff. And then I had a bunch that had gone way up, right? And so my little original, so if you take the $1,000 out for XRP, and just count that out, my $2,500 that I invested grew to like 14,000 some change, 15,000, and then and that was and that's the account value while pulling the principal out all the time, right? So if I hadn't done that, I would have probably been up even more, maybe 25 or 30,000, but it's not as safe. And so what I'm doing here is I'm hedging the risk. And don't get me wrong, this is gambling. Like, this is 100%. I wasn't doing tons of research in all of these cryptos. I was just, what I would do is I would literally open Coinbase, and if something had dropped 15 or 20% the day prior, I would put $100 in it. So I would take like your biggest losers every day and throw like $100 in it, thinking like they'll probably rebound. And then that's an easy 20% bump, whatever. Sometimes they rebound more, sometimes they don't. You know, it is what it is. But this is just a safe way to diversify a little bit in crypto, have a little fun, scratch that gambling itch, whatever, without like the risk of ruin because you're pulling your principal out. So now you're okay if it comes back down, right? So just some cool ideas. Ultimately, I was able to take my portfolio. I know I said 100x. It wasn't even close to that, actually, right? Because, yeah, that's way off. Oh, well. 10x. Yeah. I mean, I don't know, because I was pulling a ton of principal, so, you know, it is what it is. And honestly, 2,500 is probably way more than I actually contributed. It's probably only like 1,500 if you don't count the XRP. None of that really matters. The point here is the principal, right? And so you're just throwing some money in. If some do really well, you pull the principal out. The ones that go down, you leave them because eventually they might come back up. And if they don't, you know, whatever, you take a loss on a few, but overall your portfolio will grow a lot. So I'm going to do this again. I think I'm going to wait for the next time the crypto market kind of dives back down, and then I'm going to put probably a lot more than 1,500, 2,000 into it and play the exact same game on a little bit larger scale to see what happens. Yeah, so that's my thoughts. I don't do a lot of crypto content. I do use Coinbase. I'm going to link to them back down below. I think they give out Bitcoin if you use my link, which is cool for both of us. I don't really care. Bitcoin is not my favorite crypto to invest in anyway. That being said, if you want some more content on this, it's a little bit out of my realm of expertise. I'm definitely still more of a real estate index fund TSP guy, but happy to help answer any questions. And make sure you like this video and subscribe down below.